Sainsbury's has agreed to sell Argos to Swift Partners for £120 million, a decade after buying the catalogue retailer for more than £1.3 billion as part of the Home Retail Group deal. Shares in Sainsbury's rose by over 3% on the news. On the surface, that looks like a huge write-down, but the market's reaction says something different. Investors are pricing this as the removal of a problem, not the loss of an asset. The buyer, Swift Partners, is a newly formed company backed by Richard Pennycook, Trevor Strain, and Matt Truman's True Capital. Pennycook previously helped turn around Morrison's after its Safeway integration collapsed, and later led the Co-op Group back from its banking crisis. Sainsbury's chief executive Simon Roberts called it business as usual for staff and stores, and said the deal lets the group focus fully on its food business. The deal structure explains why this reads as a positive, not a retreat. Sainsbury's expects at least £70 million upfront and a further £50 million in deferred consideration, with lease-adjusted net debt falling by around £250 million. The transaction is guided as broadly neutral to operating profit, but low single-digit accretive to earnings per share, meaning the balance sheet improves while underlying profitability barely moves. Shore Capital, Sainsbury's housebroker, described Argos as a suboptimal financial performer and said the sale process had been challenging and prolonged. That is not spin. Sainsbury's had already failed to sell Argos to a Chinese buyer last year and had earlier held talks with JD Sports that also collapsed. Swift Partners is the third attempt and the first to close. Analyst reaction is split in a way that matters for how a holder should read this. Deutsche Bank maintains a buy rating with a $3.60 target, and JP Morgan has raised its target, both citing an improving equity story. But Morgan Stanley started coverage at equal weight with a $3.45 target, describing Sainsbury's as caught in the middle of an ecosystem battle against Tesco and Marks & Spencer, while Goldman Sachs and Citi have both downgraded the stock on execution and positioning concerns in a competitive grocery market. This resolves what Shore Capital calls a long-standing source of uncertainty around Argos, but it does not resolve the sharper question bears are raising: whether Sainsbury's core grocery business can hold its ground against Tesco and Marks & Spencer without the distraction of a non-food arm to sell. The Argos overhang is gone, the competitive positioning debate is not. Sainsbury's reaffirmed its FY27 guidance of £975 million to £1.08 billion in underlying operating profit and more than £500 million in retail free cash flow, unchanged by the Argos exit. The board had already authorized a share buyback of up to £300 million, running to February 2027, a capital return signal set before this disposal was even announced. The transaction is not an immediate clean break. Completion is expected in February 2027, with Sainsbury's and Argos fully separate only by February 2029, and long-term commercial agreements keeping Argos stores inside Sainsbury's, alongside Nectar and Habitat licensing arrangements. Sainsbury's keeps ongoing income from these ties even as Argos leaves the group's balance sheet. The evidence supports a specific bounded reading rather than a simple bull or bear call. Sainsbury's has removed a chronically underperforming, twice failed to sell asset and improved its debt position by roughly £250 million, which is why Shore Capital and Deutsche Bank see the move as constructive. But Morgan Stanley's and Goldman's downgrades reflect a real risk that remains untouched by this deal, whether a food-only Sainsbury's can out-execute Tesco on price and Marks & Spencer on quality. Fuller financial detail is due alongside Sainsbury's first half FY27 results, which will be the first real test of whether the simplified balance sheet translates into the margin and cash flow improvement the company is promising.